So hello everybody. Today I'm going to share this little video because I want to highlight some of the knowledge on chapter 13, statement of cash flows. I think you have done the homework for Monday and you understand like some of the materials, or I think you might have learned a statement of cash flow for Financial Accounting 201, so that you it's kind of another review for you. So there's something that I want to highlight about the three activities, kind of remind you that we have three activities about cash flows: operating, investing, and financing. And something I want to highlight is about the dividends and interest. So if you can look at that, so if we pay the dividends, and that belongs to financing activity. However, if you have interest or dividend income, the revenues is going to be classified as operating activities. And then this is something that people are easy to confuse about. So I just want to highlight this kind of thing. And interest expense is also classified as operating activities. So just remember that for interest and dividends, only the paying of dividends is a financing activity. The interest, the income, and dividend income and interest expenses are classified as operating activities for cash flows. Okay, so so this table is an income statement, kind of remind you what we had for our income statement, and we did income statement in our financial accounting as well. And we have sales on top and cost of goods sold, and then this is a gross profit and minus operating expenses. Then we have our operating income, then we deduct all these other non-operating income and expenses, then we're gonna come to our net income. Then I'm going to talk a little bit about direct or indirect method for cash flow statement. So when we talk about direct or indirect method, we're basically only talking about operating activities only. So the accounting or the preparation for financing and investing activities are the same for both the direct and indirect method. And so kind of reminder, for the indirect method, usually we start up with net income, and then we have all these adjustments. And if you want to summarize, so basically we only have 4 kinds of adjustments. So the first is usually put it up front because it's every firm, not every firm, but most of the firm will have depreciation expense, and you want to add back this depreciation expense because depreciation expense is non-cash expense, so we want to add it up. And then also we have gains or losses on sale of equipment. Again, these are non-cash gains or loss. So we're gonna deduct it if it's a gain, and we're gonna add it back if it's a loss, okay? And also, we're gonna have the adjustments for current asset or current liabilities. And then if you can remember, for any increase in current asset, we're gonna do a deduction from our net income. And then for any increase in current liability, we're gonna add it up to our adjustment, to our net income to reach our net cash provided by operating activities. The argument behind that is that if you have more current assets, then probably you paid more, okay, to get these current assets, or you haven't collected enough from your customers. But for all these liabilities, so easy way to understand that if you increase your current liabilities, like the liquid liabilities, probably you have more liquid asset as well. And these are the cash inflows. So this way, we added up for our cash flow statements, operating cash flows. So this is just an example, and you can read that through this video. These are the notes I used to use for my face-to-face class, but I probably will not post this online, but if you need that, I probably will. Just because I think you can have enough notes from the textbook and the course contents, and I want to add more burden to you, okay? So the direct method is more challenging, and like most, it is not recommended anymore, but we need to understand how we reach out the direct method. So when you try to tell what is a direct method cash flow statement, usually it starts with cash. You see all these items starts cash received or cash paid, and then something like that is direct method, because we just calculate all these cash items and how these cash items change or receive or paid, okay? So how do we prepare the operating activities using, let me see, direct method? So indirect method I just introduced, but how about we use direct method? Okay, so this is just an example how we reach out, how we use direct method to calculate operating activities. Okay, so I will just do one example with you. It's cash received from customers. How do we calculate cash received from customers? If we collect cash from customers, it's most likely to be a collecting of our accounts receivable. Okay, so on our balance sheet, we have a beginning accounts receivable. And what can add up to our beginning accounts receivable and what will increase our accounts receivable is when we sell more, right? If we have more sales, if we increase sales revenue, it will be more likely to add up to our accounts receivable. And then if we use beginning accounts receivable to plus sales revenue, that is going to be our whole amount, like total amount of accounts receivable of this period. However, we may not have this at the end of period, because some customers may pay us back, and then we would like to see this number. So cash collections from accounts receivable are actually going to be used to our direct method of cash flows. And then how can we know what is the amount of cash we collect from our customers? We have the ending account receivable, right? And then if we want to know what is our cash collection from our customers, we simply use beginning accounts receivable plus sales revenue to minus ending cash, ending accounts receivable, ending accounts receivable. Then we are going to get our cash collections of AR. And then this is another way to have a look at it, okay? AR at the beginning of the year plus current year sales minus AR at the end of the year. And we're going to do the same for our expenses, for example. So this is an example too of like a cash payment to employees. So how can we reach our cash payment to employees? We have a beginning of wages payable, right? And then what can increase our wages payable is wages expense, right? We recognize expense, but for the most time, if you remember in 201, we're gonna recognize the wage liabilities, and then we have, if the expense happens, we're gonna add this amount to our wages payable. So if we use beginning wages payable plus wages expense, that is going to be the whole, like the total amount of wages payable in this period. And how do we know how much we pay to employees? Again, we're gonna know our ending wages payable, you know, the wages payable at the end of the period. So let's give you an example. Like if at the beginning, our wages payable is $1,000, for example, and then wages expense happen like $3,000, and then at the end, our ending wages payable is 1,500, and what is our wages payment to employees? Then we are gonna use the 1,000 plus the 3,000 and minus the 1,500, and which will give us 1,500 as well. So 1,500 is going to be our payment to employees. I think all these functions are going to be on your textbook, and I'm just going through these examples to you to help you understand material. Let me know if you have any other questions, and reach me through email or office hours. I'll be happy to answer your questions. Okay. Well, thank you and bye.